A wildfire damaged rental properties in Fort McMurray. The insurers paid approximately $6.5 million for the physical damage, but a separate claim for about $4.4 million in lost rental income became a much harder fight. The properties had been damaged. Tenants could not occupy units for weeks. An evacuation order had interrupted the business. So why did the rental income claim change after the fire? The answer turns on a basic insurance idea that becomes complicated in real life. Indemnity. A policy may respond to actual loss, but the calculation does not freeze at the moment the fire happens. What happened afterward can change what was actually lost. This episode is based on Shelter Canadian Properties Limited v. Aviva Insurance Company of Canada, 2023 ABCA 74, a decision of the Alberta Court of Appeal. Shelter managed 13 multi-unit residential rental complexes in Fort McMurray owned by Lanesboro Real Estate Investment Trust. The policy covered loss of rental income resulting from damage or destruction caused by covered perils, including wildfire. The visuals are a dramatized reconstruction. The narration separates the public record from educational interpretation. The result turned on the specific policy wording, the evidence of actual loss, and what happened after the properties reopened. Before the wildfire, the properties generated rental income through ordinary operations. Shelter was the property manager. Lanesboro owned the rental portfolio. The insurance policy was commercial coverage purchased for those properties, with protection for physical damage and loss of rental income caused by covered perils. That distinction matters. The policy was not simply promising a fixed payment whenever rent fell. It connected the rental income protection to damage, interruption, and the amount of loss that could actually be established. In May 2016, a nearby wildfire led Fort McMurray Civil Authority to issue a mandatory evacuation order. The order was lifted on June 2nd, but reopening the city did not instantly restore the rental business. The properties had resultant smoke damage, and units remained uninhabitable for weeks afterward. That created a clear sequence: a covered wildfire, physical damage, a period when tenants could not occupy units, and a claimed loss of rental income. The insurers paid approximately $6.5 million for the physical damage caused by the fire. That payment is important because it separates two issues that are easy to blend together. The existence of covered property damage was not the entire dispute. The separate question was how much rental income was actually lost because of that damage, and how the policy defined and calculated that loss. One part of the claim had a payment. The larger rental income calculation still had to be tested. The insured claimed $4,430,475 for lost rental income. The insurers disputed the amount and argued that the policy only covered actual loss. Their position was that the post-fire increase in rent meant the insured's overall net rental income had increased, even though the properties had been unavailable for a period. The dispute was no longer only whether the policy could respond. It was whether the claimed number represented the loss the policy was designed to indemnify. The insured took the position that it was not restricted to the insurer's preferred actual loss calculation, and that the claimed amount fit the policy's definition of rental losses. The insurers argued that the policy was an indemnity contract. That meant the payment had to correspond to the actual loss suffered. The post-fire rent increases were not being treated as a reason to deny that a fire occurred. They were part of the evidence, used to calculate whether the rental business had ultimately suffered the amount claimed. This is the central reveal. Rental revenue can stop during a period of damage and still not equal the final amount recoverable under an indemnity policy. Indemnity is designed to compensate the actual loss, not create a profit from the loss. That requires evidence. What income would likely have been earned? What income was actually earned? What expenses continued? What expenses were saved? How quickly the property could be restored? and what reasonable steps were taken to reduce the loss. The calculation is a story over time, not a single number taken from the worst day. The Alberta Court of Appeal emphasized that this was an indemnity policy. The policy's gross rentals provisions included methods for calculating an actual, quantifiable loss. The policy also contained an express mitigation clause, requiring reasonable steps to minimize loss. The court reduced the damages award to account for the increase in net rental income after the wildfire. The lesson was not that rent increases were improper. The lesson was that the final indemnity calculation had to account for the economic result of the insured's recovery and mitigation. This case does not say that physical damage automatically produces no rental income recovery. It does not say that an insured must absorb every consequence of a wildfire. It does not establish one calculation for every rental property or every business interruption policy. It shows the difference between coverage entitlement and loss quantum. Even where a policy responds, the amount payable can depend on actual loss, mitigation, records, and the policy's calculation language. Before a property loss, owners and managers can ask practical questions. How does the policy define rental income or business income? What period of restoration and waiting period apply? Which mitigation steps must be documented? What records establish expected rent, actual rent, continuing expenses, and saved expenses? And if rents change after the loss, how will those changes be treated in the calculation? These questions do not guarantee a claim result. They make the eventual conversation more evidence-based. The wildfire created physical damage. The properties were uninhabitable for a period. The rental income claim was real, but the amount did not exist independently of what happened afterward. Under an indemnity policy, actual loss, mitigation, and the policy's calculation language matter. The fire started the claim. The records, the recovery timeline, and the post-loss rental result finished the calculation. This has been an insurance case file. The source is linked in the description. The episode is educational information only, not insurance or legal advice.